Welcome back to The Financial Edge, the podcast that helps you understand the forces shaping your portfolio. I'm your host, Alex, and today we are diving deep into a topic that affects every single one of us, whether you're a seasoned investor or just keeping an eye on your savings. We're talking about the ancient dance between the US dollar and gold. With me today is our resident financial strategist, Jessica. Jessica, thanks for being here.
It's great to be back, Alex. This is one of those subjects that sounds academic, but it boils down to something really fundamental: trust, and what happens when that trust starts to wobble.
Introduction and context. That's a brilliant way to put it. Let's start there. We use the dollar every day. It's the global reserve currency. But at its core, it's a fiat currency, just paper backed by faith in the government. What is gold, then, in contrast to that system?
Well, gold is the ultimate antithesis. The dollar's value is purely derived from trust and the government's promise. Gold, on the other hand, has intrinsic value. It's been universally accepted as a medium of exchange and a store of value since antiquity. It's scarce, it's costly to extract, and no central bank can just print more of it. It's the original debt-free asset.
So if the global financial system is, say, a huge dominant aircraft carrier, which is the US dollar, what role does gold play when the sea gets rough?
Gold is the lifeboat. When you see stormy waters, rampant inflation, a major geopolitical crisis, or a deep recession, investors quickly want to get off the volatile aircraft carrier and into something guaranteed to float, independent of the government issuing the currency. That dynamic is why we see this perpetual, complex, and usually inverse relationship between the two.
Core discussion, the inverse correlation. Let's unpack that inverse relationship because it's the core concept here. The general rule is when the dollar strengthens, gold tends to fall, and vice versa. Why? And how did history bake this into the system?
The history is crucial. We have to go back to 1971, to the Nixon shock. Before that, we had the Bretton Woods system, where the US dollar was tied to gold at a fixed rate of $35 an ounce, and other currencies were tied to the dollar. The dollar was the gold substitute.
Right, so the dollar had a physical promise behind it.
Exactly. But between the Vietnam War and rising public spending, the U.S. was printing far more dollars than the gold reserves at Fort Knox could realistically cover. In 1971, President Nixon unilaterally ended the dollar's direct convertibility to gold. That was the moment the dollar became a pure fiat currency, and gold was freed to float.
So 1971 is the key moment. Gold became the independent barometer of confidence in the dollar.
That's the takeaway. Now, let's look at the two main drivers of the inverse correlation today. First, pricing in dollars. Gold is globally quoted in USD. So if the dollar weakens, meaning it takes less foreign currency, say euros, to buy one US dollar, then gold automatically becomes cheaper for those international buyers. That surge in demand drives the price of gold up.
It's an immediate automatic discount for everyone outside the US. That makes total sense. What's the second driver?
It's the safe haven effect and what we call opportunity cost. When the global economy is stable, investors chase returns, and the dollar is the go-to currency. But when panic hits, the dollar is the default liquid safe haven. When the dollar is strong, investors feel secure, and they don't need the secondary insurance policy, which is gold. The demand for gold drops.
And the flip side of that is the opportunity cost. If I can get a guaranteed 5% return on a safe U.S. Treasury bond, a dollar-denominated asset, why would I hold a non-yielding lump of metal?
You wouldn't. Not unless you're truly terrified of inflation. High interest rates set by the Fed directly raise the opportunity cost of holding gold, making the dollar more attractive. Conversely, when the Fed cuts rates or does quantitative easing, the dollar's yield falls, and gold starts to look much better as a capital preservation asset.
Modern dynamics and geopolitics. That brings us to the modern dynamics, which are getting complicated. We have rising U.S. debt and this concept of de-dollarization. How is that affecting gold?
This is where things get truly interesting. The dollar's dominance was cemented by the petrodollar system, where oil is traded globally in USD, creating artificial demand. But countries like the BRICS group, Brazil, Russia, India, China, and South Africa, are actively trying to bypass the dollar for trade.
They want to reduce their dependence on the U.S. political and financial system.
Exactly. And the most significant response we're seeing is central banks buying gold at record levels. They are diversifying their national reserves away from the dollar. When massive institutional buyers like central banks rush into the market, that is a huge structural demand driver for gold, pushing prices up, regardless of the daily dollar fluctuation. It's a hedge against future dollar depreciation and geopolitical risk.
It's a fundamental shift, moving gold from being purely an inflation hedge to also being a geopolitical hedge. Practical application and conclusion. Let's shift to the listener's perspective. What are the two most actionable tips or metrics they should watch to forecast this relationship?
The number one thing to watch, even more powerful than the dollar index, is the real yield on 10-year U.S. Treasury bonds.
Define that for us simply.
The real yield is the interest you earn on a Treasury bond minus the inflation rate. If the real yield is negative, say you earn 4%, but inflation is 5%, you are guaranteed to lose purchasing power by holding the dollar.
Oof.
When the real yield is negative, the opportunity cost of holding gold effectively turns negative too. The market realizes that fiat money is guaranteed to lose value, and they rush to buy gold. So watch that 10-year yield. If it's sinking into negative territory, that's a huge bullish signal for gold.
That's fantastic. It's all about protecting purchasing power from the silent thief of inflation. What's the second tip?
Just keep an eye on the DXY index, which measures the dollar against a basket of currencies. A declining DXY is typically a short-term bullish indicator for gold. And remember the core lesson. Gold is your insurance policy against inflation, against geopolitical crisis, and against systemic fragility of the fiat currency.
That puts it all in perspective. Gold is the anti-dollar. It's a strategic hedge, not just a speculation. Jessica, thank you so much for breaking down this essential financial secret for us.
My pleasure, Alex. Knowledge is truly your best asset.
Absolutely. And to our listeners, we hope this has helped you transform your understanding of the global economy. Until next time, keep your financial edge sharp.